Good day, guys. Welcome to Trading Arbitrage Opportunities with Calvin Potts. Welcome to episode 36. Here we have a Euro Pound trade. This is a beautiful, remember, a Euro Pound uh, is a positive carry when we are going bearish. We had a bullish move where we had to leave the pound, the euro pound trade. We had to buy the pound with the CHF so that we can survive. We had to add other currencies too. And at that moment, the currency with the lowest interest rate or differential was the euro and the JPY or the CHF at that moment. So we had to do away with the pound and trade the euro by itself to buy this entire move. It's visible on the. I'll try to open that part over there. It's visible on pound JPY, pound CHF. It's visible on that side, and I hope I'll be trying to show you how we have this trade. You cannot see it from here. It's taking time. Okay, I'll wait for it to open up. Oh, yeah, it's pretending that it had opened. So my laptop is actually overheating. We did not buy the most expensive laptops for trading. So here you can see that the trade that we took with the CHF did not work for us. So the trade that we took with the JPY did work for us because at that month the the CHF was bullish and the JPY was getting weaker and weaker. So this is how we were able to hold the trade. Remember, what we trade is first touch, second touch. The third touch has to manipulate. It has to break below it. This thing will repeat itself over and over again. I told you that when when macroeconomics tells us to buy a currency on the 28th of Feb, which is, I hope you can see the date here. On the 28th of Feb, if macroeconomics tells us to buy the EURJPY, the market maker's job is to push the market lower. The market maker does not have that 30 billion to push the market up there. So they don't trade with their money, they trade with our money. So what they do is that they push the market lower to collect the stop losses that are down here. The stop losses that are down here. They know that your stop losses, you're expecting the third touch to land here and take off. So your stop loss is somewhere down here, and the market makers collect your stop loss. And let's say they, instead of investing 30 billion, they invest 100 million just to create this wick, and they stop you out. When they're done stopping you out, they're able to make that 30 billion that can push the market higher. So what they risk is 100 million. All the money that they had to risk was 100 million. Now they have enough money, which is 30 billion, to push the market higher. So this thing repeats itself over and over again. This thing is a Wyckoff schematic. I'm going to explain to you what Wyckoff schematic is. So this is the spring. What makes you understand that the longs are being priced in is when you see the spring. This is the spring and this is the test. This part here is the test. So this wick that breaks below, it tells you that volume is coming into the market. Now, how do you know, how do you see volume? You see volume by breaking the previous low. This is the shoulder of the previous low and breaking the next high and the market coming back to land on the 23.6 and taking off. So this thing is maroon, but it's actually it's orange, but it's actually the 23.6. So the market made that 50% feed and it came back to the 23.6 below it and it took off. So these are the trades that repeat themselves over and over again. Here I was looking at shorts. I was looking at the euro and trying to ascertain how the shorts are coming in on the euro, but this trade will continue higher because the JPY is getting weaker and weaker, and that is a trade that I'm talking about called a major bust. But the euro is not exiting the recession just yet. The only thing that is happening here is because the global economy, as I was showing you with the S&P 500, the global, the S&P 500 or the US stocks and the volatility index, they exit the recession before the global economies get to exit the recession. So they show you something like they show you a signal that says the global economies are exiting. When they break this high, when we get into a recession, they need to collapse. This signal is telling us that we're getting into a recession. When they break the next high, they're telling us that we're exiting the recession. So this signal is telling us that most global economies are getting out of recession. So the major bust that I always talk about is when the market breaks, the forex market, the foreign exchange market breaks the next high to move higher. Let's go for the weekly time frame. This currency is really okay. When we break this high, moving higher, we call it a major bust from down here all the way up there. When the euro is exiting a recession, but the euro is not exiting the recession just yet. The only difference is because the JPY is a safe haven, and this JPY is pricing in it's pricing in what you see on the uh, the 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 JPY on the S&P 500. What you see on the S&P 500 is the pricing in of the exit of the recession. So those are leading indicators. Those stocks, those stock indexes are the leading indicators. So when we exit here, it looks like it's a major bust. It looks like the euro is exiting the recession, but the euro is not. It is the JPY that is getting weaker and weaker, meaning that the JPY is pricing in the exit of the recession. Safe havens when the economy is booming, safe havens collapse. When we move towards a recession, safe havens gain strength. So the JPY was bullish. It was bullish. That's why the market was moving sideways. It was bullish, and then it started to price in the exiting of the recession, and that's why we have the market moving higher like that. So it's just this move is not because the euro is exiting the recession. It's just because the JPY, the safe haven, is creating a duplicate or what we call a replica of what we see in the exiting of the recession in the S&P 500. So here with the euro pound, the macroeconomic outlook on the pound is that the inflation that we are hedging on the pound is actually, in fact, both currencies are doing well in terms of inflation and GDP. They're showing us that they're moving towards. In fact, the pound, the interest rate cuts on the pound were hawkish interest rate cuts. I will explain what hawkish cuts and dovish cuts and hawkish hikes and hawkish interest rate cuts are. But the interest rate cuts on the pound were hawkish, meaning that the economy on the pound was not really doing that. They were not that bad for interest rate cuts to be introduced on the pound. So when they create what we call hawkish cuts, they actually because the economy is not doing that bad, the currency pumps higher. It becomes a very bullish currency because of those interest rate cuts, and because these guys are not doing very bad in terms of how they cope with economic conditions in the recession. An interest rate cut makes money even cheaper for them to take loans and for the businesses to do well. So the interest rate cuts on the pound were hawkish cuts, and the interest rates on the euro were actually dovish cuts. So those cuts for the euro were correct. And in terms of comparing the two currencies, the euro and the pound, the pound is doing well in terms of inflation and GDP. It was doing well even before they started cutting interest rates. So the euro is the currency that it is doing well, but is not doing as well as the pound. So for the inflation and the GDP in the euro to for the time for the euro, the euro's GDP and inflation to catch up with the pound is the arbitrage opportunity that we're taking. Of course, the euro will actually put up a good fight into this trade, and it will not allow the market to, it will not allow the pound to do as it wishes. So it will fight. The trade will, it is a positive carry, but the trade will not trend as fast as what you see here. It will trend downwards, but with small candles like the candles that you can see here. So that's the trade that I'm looking at. Here we also have a Wyckoff schematic. This is the previous shoulder. The market broke the previous high, went up here, landing on the primary trend line, which is the weekly time frame trend line. So when it landed here, it created what we call the spring because it took out the previous high, and it did not show any intentions of breaking it. So the trade will continue because the euro, in fact, the Danish krona, had already priced in bearish economic reports, and the euro is beginning to price in bearish economic reports, meaning it's getting weaker and weaker, and the pound is gaining strength. So the direction of the trend will be downwards. So that's the trade that we're looking forward to. And this is not actually the actual trade that we're looking at. The actual trade is down here. So this market has to come to the 50% FIP and give us a pullback. That's what you see here. This part here, that's what you see here. And it has to come down here so that we can take profit. And it will reverse, of course. And reversing, I expect it to reverse into this. I don't expect it to go all the way up there. So it will reverse and drop lower. So those are the expectations because this is the previous shoulder that was taken out by this wick. That's why I have this. This is what they call an order block. So this is the previous the last bullish candle before the drop. So that's why I have these lines here. But this one is for this shoulder here is for the previous break that we had, and the market dropping lower. Goodbye, guys. I'll see you on the next episode.